In the ever-evolving landscape of finance, leveraged ETFs have emerged as powerful tools for sophisticated investors. These exchange-traded funds are designed to amplify the daily returns of a specific index or asset class. While they offer the potential for significant gains in a short period, leveraged ETFs are inherently complex and come with substantial risks. This essay delves into the intricacies of leveraged ETFs, providing a comprehensive overview for both beginners and seasoned traders. We'll unravel the mechanics behind their amplification strategies, explore the crucial concepts of daily rebalancing and compounding, and highlight the reasons why these instruments are generally unsuitable for long-term investments. Whether you're a novice investor seeking foundational knowledge or a seasoned trader looking to refine your understanding, this guide will equip you with the insights necessary to navigate the world of leveraged ETFs with greater clarity and caution. Remember, knowledge is your most valuable asset in the world of finance. The term leverage in finance refers to the use of borrowed capital to amplify potential returns. Just as a lever helps lift heavier objects with less effort, financial leverage allows investors to magnify their exposure to an asset's price movements. In the context of ETFs, leverage is employed to achieve returns that are a multiple of the underlying index's daily performance. For example, a 2 times leveraged ETF seeks to deliver twice the daily return of its benchmark index. If the index rises by 1%, the ETF aims to gain 2%. Conversely, if the index falls by 1%, the ETF would typically experience a 2% decline. This magnification effect can work both ways, amplifying gains when the market moves in your favor and exacerbating losses when it doesn't. It's crucial to understand that leverage amplifies both profits and losses. This inherent characteristic makes leveraged ETFs inherently riskier than traditional ETFs that track an index without the use of borrowed capital. Leveraged ETFs achieve their daily return objectives through the strategic use of derivatives and debt. Derivatives are financial instruments whose value is derived from an underlying asset, such as an index or a commodity. Common examples of derivatives used by leveraged ETFs are futures contracts and options. Futures contracts are agreements to buy or sell an asset at a predetermined price on a specified future date. Options, on the other hand, grant the holder the right, but not the obligation, to buy or sell an asset at a specific price within a defined time frame. By strategically utilizing these derivatives, leveraged ETFs can gain magnified exposure to the daily price movements of the underlying index. In addition to derivatives, leveraged ETFs may also employ debt to amplify their exposure. They might borrow money from financial institutions, using the borrowed funds to invest in the underlying index. The interest paid on this debt is factored into the ETF's expense ratio, which tends to be higher for leveraged ETFs compared to traditional ETFs. Leveraged ETFs are often categorized based on their leverage ratios, which indicate the degree of amplification they seek. Common leverage ratios include 2-to-1 and 3-to-1. These ratios represent the target daily return multiple relative to the underlying index. A 2-to-1 leveraged ETF aims to deliver twice the daily return of the benchmark index. For instance, if the S&P 500 index rises by 0.5% on a particular day, a 2-to-1 S&P 500 leveraged ETF would aim to return 1%. Conversely, if the index falls by 0.5%, the ETF would typically decline by 1%. Similarly, a 3-to-1 leveraged ETF seeks to generate 3 times the daily return of the index. If the index climbs 0.33% in a day, the ETF strives for a 1% gain. If the index drops 0.33%, the ETF would likely experience a 1% loss. It's crucial to remember that these leverage ratios are based on daily performance. Over longer periods, the compounding effect of daily rebalancing can lead to significant deviations from the stated multiples. Section 5. The Daily Grind. Rebalancing and its impact. Daily rebalancing is a fundamental characteristic of leveraged ETFs that contributes to their complexity and potential for unexpected outcomes. Unlike traditional ETFs that passively track an index, leveraged ETFs actively adjust their holdings on a daily basis to maintain their target leverage ratios. This daily rebalancing process can have a significant impact on the ETF's returns over time, especially during periods of high market volatility. To illustrate, consider a 2-to-1 leveraged ETF tracking the S&P 500. If the index rises by 1% on a particular day, the ETF would aim to gain 2%. To maintain the 2-to-1 leverage ratio, the ETF manager needs to purchase additional securities to increase the fund's exposure. Conversely, if the index drops by 1% the following day, the ETF would typically decline by 2%. To rebalance, the ETF manager would then need to sell some of its holdings to reduce its exposure. Section 6. The compounding conundrum. When amplification works against you. While leverage can amplify gains during favorable market conditions, it's essential to understand that compounding works both ways. Just as positive returns are magnified, so too are negative returns. This compounding effect can erode the value of leveraged ETFs over time, especially during periods of high volatility or extended downturns. For instance, consider a hypothetical scenario where an index experiences a 10% decline followed by a 10% gain on consecutive days. A traditional ETF tracking this index would end up roughly where it started. However, a 2x leveraged ETF would experience a 20% loss on the first day and a 20% gain on the second day. Due to the compounding effect, the 20% gain on the second day is calculated on the reduced value after the first day's loss. The ETF would end up with a net loss, even though the underlying index remained relatively unchanged. This phenomenon, known as volatility decay, highlights how leveraged ETFs are poorly suited for long-term investments, as even small daily fluctuations can lead to significant erosion of value over time. Section 7. Long-term pitfalls. Why leveraged ETFs aren't built for the long haul. While leveraged ETFs can be enticing for their potential to generate substantial short-term returns, they are generally unsuitable for long-term investment strategies. This unsuitability stems from the inherent risks associated with leverage, daily rebalancing, and the compounding effect, all of which can erode value over extended periods, especially during volatile market conditions. As we've explored, leverage amplifies both gains and losses. While this can be advantageous for short-term trades, it can be detrimental for long-term investors, as even small market fluctuations can lead to significant deviations from the underlying index's performance. Moreover, the daily rebalancing process, while necessary to maintain the target leverage ratios, can result in a phenomenon known as beta slippage. This slippage occurs when the ETF's returns over time deviate from the expected multiples of the underlying index's returns, often due to the compounding effect of daily adjustments. Section 8. Navigating the terrain. Advice for beginners and seasoned traders. For beginners venturing into the world of ETFs, it's generally advisable to start with traditional unleveraged ETFs that track broad market indices. These ETFs provide diversified exposure to the stock market without the added complexity and risks associated with leverage. As you gain experience and a deeper understanding of market dynamics, you can gradually consider incorporating leveraged ETFs into your portfolio, but only after conducting thorough research and understanding the associated risks. Seasoned traders, on the other hand, might consider using leveraged ETFs as short-term tactical trading instruments. These ETFs can be used to capitalize on anticipated market movements or to hedge against potential losses in other portfolio holdings. However, even experienced traders should exercise caution when dealing with leveraged ETFs and implement appropriate risk management strategies, such as setting stop-loss orders and diversifying across asset classes. Section 9. Conclusion. Leveraged ETFs. Proceed with caution. Leveraged ETFs are powerful but complex financial instruments that can amplify both gains and losses. While they offer the potential for significant short-term returns, their inherent risks, including leverage, daily rebalancing, and the compounding effect, make them generally unsuitable for long-term investment strategies. Beginners should prioritize building a solid foundation with traditional unleveraged ETFs before considering leveraged ETFs. Experienced traders, while potentially utilizing leveraged ETFs for short-term tactical trades, should proceed with caution and implement robust risk management strategies. As with any investment, knowledge is key. Thoroughly research and understand the intricacies of leveraged ETFs, including their mechanics, risks, and potential rewards, before incorporating them into your portfolio. Remember, in the world of finance, informed decisions are your best defense against unexpected outcomes.